Hi, fellow traders. What's happening? I hope you guys had a great week. I hope it was a lot better than mine. I didn't finish the month of May the way I wanted to, but the month of May was really, really good month, especially considering the way April was. So, May, with the exception of the last week, kind of um, rivaled the first quarter. And I think that's what I was trying to do, and I think I pressed it a little bit too hard um, on last week, and it's what got me to max loss red days in the middle of the week, and just kind of put me on my heels. But it's part of the game, and understanding and being able to identify what you did and what you have in place to fix it can get you back on track and keep you from digging deeper holes. And all of this is that I'm sharing with you is what I'm trying to help you guys get to that point. It's all about building that consistency in your trading. And we're at the third exit on the first stop of this roadmap to your success. And building consistency is really the foundation of that. And there's a reason why I waited a week to get this third stop out, or this third exit out, because I wanted what we talked about the first two lessons to resonate with you, and hopefully put it into practice to see just how much it could help you be a more consistent trader. But we'll get into that here in a second. I want to take a brief moment to pause and recognize, Memorial Day is Monday. The markets are closed, and it's a day that we remember and honor those who gave that ultimate sacrifice to protect the freedoms that we have today. And it's a whole different meaning for those of us that have been in uniform, that have lost, mates in the line of duty. And it's a really, really special day, probably one of the most special days out of the year for me. So it's not about cookouts, hamburgers, hot dogs, apple pie, and homemade ice cream. It's going to the lake and the beach and all that. It's about remembering those that allow us to have those freedoms and the opportunity to do those things. So I wanted to take a minute to share that with you, and really to remind you that also that the market is closed on Monday. So just to do a quick review, we talked about defining our process, which is the beginning of the foundation for our trading. It's how we get from the beginning to the end of our trading day. And, stop exit A, 1A, we talked about defining our strategy, how important it was to establish the rules of engagement, and that these need to be set in stone. These need to guide you in your trading every day. And then the last lesson was stop 1B, define your risk. We talked about how important it was to set max loss parameters in your trade. Max loss per trade, max loss per day. And honestly, you need a max loss per week, because you can, take out your week's max loss, you can sneak up on it. But it's setting those parameters so that you never, ever put your account in danger. You never risk your account. And that's the professional traders. I know they're trading with a larger sum of money, but they never put a significant percentage of that account in danger. The ones that do tend to get caught. Yeah, it works out every now and then, but you end up getting caught. Just like with the GameStop debacle. It sneaks up on you from ways that you'll never think. And a lot of people lost a lot of their net worth, the big guys. But the smart ones always hedged, and whatever they lost, it was not a big deal. And that's how we have to go through and make sure that we're doing these things. So, if you just do the first couple of things that I shared with you, you'll be doing more than what most traders do. Most retail traders who are trying to become a trader. You're doing what most of them, aren't able to do. All right, so today, this is the last exit in stop 1, is we're talking about our stop loss parameters. There are different stop strategies that we could use. There's a candlestick strategy, which is the simplest, and what I recommend brand new traders use to help them in developing their discipline and stopping out. There's a range strategy and a technical strategy, and I kind of use a mix of the range and the technical strategy. And I'm going to show you that. And as we're going to kind of mix in the position sizing, because they all work hand in hand. There's a flat rate position sizing strategy that says, no matter what, I'm going to take 100 shares per trade, or I'm going to take 50 shares per trade regardless. This is what a lot of newer traders use when they're first starting out, because you're trying to learn. There's a process. So if you have a flat rate and you use a candlestick strategy to stop out, you're going to spend time in the market. You're going to learn how to read price action. You're going to understand what you're seeing a lot better. And you'll be able to add traditional rules of engagement to the strategy that you're trading. It works. And the people that do it and do it the right way end up becoming successful. And also you have a risk-based position sizing, where you risk a certain amount of your account, a certain percentage of your account. Some people have hotkeys that will allow them to get in a position using a certain percentage of their overall account. So, you've got that. So we're going to talk about, all of those today. But I want to share this pyramid with you to kind of help you understand where we're going. If you haven't figured it out yet, this is going to help you. I would print out the first slide that I showed you in the first 2 videos and this slide. Put it on your monitors, put it on your desk, so that you understand, where you're going. Now, today is the last day of building this trading foundation. And we know the foundation is always underground. Nobody sees it. But it has to be solid. You can't shortchange the foundation. It has to be dug out properly. The ground has to be set. And every component, every aspect of the foundation has to be put in place, because if it's not, it won't hold your trading house and it will come down. So, and you see, these are the things that we talked about: the process, the strategy, the mental skills, having realistic expectations. This is what kills me all the time. And I've been trading for years, but I have unrealistic expectations when it comes to certain trades. If I go in and this trade has the most perfect chart and I enter it perfectly, I didn't anticipate everything, it confirmed, I'm expecting that trade to work. And when it doesn't, that's when I lose it. So I know what I have an issue with. It's something I've been dealing with. But what I have to do is I have a process to deal with it when it comes up. So I go through my range of emotions and then I deal with it and I put it back together. And then managing risk. This is what we've talked about the last class, and we're going to talk about this class. But as you move up above ground, once you get the foundation, you build a framework. And we're talking about how we build a house here. You frame the house out. If you shortchange the frame, if you don't frame the house properly, it'll never hold a roof. And the roof will come crashing down and take out the house. So you have your trading foundation, which is critical, and then you have your trading framework, which is another load-bearing component of your trading. So these two things pretty much work hand in hand to support the house, or it's going to support your trading house. And then we're going to move up to building out your trading weaknesses and turning your weaknesses into strength, the ones that you identified. We start adding strategies here. Like for me, it was aftermarket strategy, the earning strategy, the all-day hold, trading pre-market. We're adding all of those things, which I can't wait until Monday. I'm able to get back to the pre-market deal and really engage in the early morning trading. So you guys stay tuned for that. But all of these things, and as we just continue to go up, then we have to insulate. Once we build out our house, we install the plumbing, the electrical, everything that we need onto the framing. Then we can insulate it and build the walls, and you never see the frame. Just like the foundation, the framework you never see. Nobody comes in the house after it's built and says, "Ooh, this is a beautiful foundation," or "This is a beautiful framing of the house," because you never see it. These are the things that you just don't see. And so once we put the walls, the drywall, and the insulation in, we're insulating our trading. We're protecting it from the outside elements, which we're filtering out all of that static, all of that noise from, people that we should never, ever be listening to. And there should be a law against them being on YouTube. But we're able to filter out all of that. We're able to adapt when the market conditions change to where we're not making wholesale changes. We're just tweaking our strategies. And we get to the point where we just rinse and repeat every day. And we do a little bit of maintenance and repair when we have to. But this is the process. This is what we're heading towards. This is the peak that we're going to reach, guys. So trust me, this is where we're going. I'm not a Johnny come lately. I've been doing this, and I took the hard road. Some of you guys have known me from day one. And when I was in a trader in Warrior Trading, before I even became a moderator there. So where I've been and where I've come from. So believe me, when I tell you this stuff, this isn't some bullshit that I came up with just to be talking. This is stuff that I've lived and that I use every day. And that's why I do what I do. You're able to see it happen every day live. And I think that's critical. All right, so let's get into what we're going to talk about today. All right, so I apologize. I did not take a snapshot of my trades from yesterday that I wanted to kind of use. And some of the charts from yesterday, it just totally slipped my mind. We went to get Mexican, and I ended up getting this big margarita. When I got home, I fell asleep on the couch, and then that was that. It was one of those nights. I guess I drank the week away. But here, my strategy is the opening range breakout breakdown. You know, some people have a love-hate relationship with it. I think the people that hate it are the ones who cannot trade it. They don't have the discipline to trade it. And to stick to, you're going to pick the wrong stocks, and you can pick them 2-3 days in a row. You see me do it all the time. But when you get the right ones, they far outweigh picking the wrong ones. And most of the time, it's my fault anyway. So, can't blame it on the strategy. But here in CRM, my strategy is I'm going to buy the break of the 5-minute opening range high. So, the entry triggers. So, the question becomes, how do we manage our risk on this? What are the stops? What are the stop strategies that I can use to help me manage my risk? I'm ready to trade this. So first, we need to figure out how much room do we need to give this stop in order to allow us a good chance at making profit. All right, so I do that by measuring the average true range of the candlesticks, the last 6 candlesticks, the last 30 minutes of trading. I do incorporate the initial first candle because that's going to be critical. Now, some people will look for the largest candle and then take the range of the largest candle and use that as a guide. For me, I don't want to do that. I want to know what the average is. So on here, I've got, if you look at the bottom of this box, if I move the arrow, the cursor, it'll disappear. Down at the bottom, you see it says average true range and $1.64 or 1.64. That's the average of the last 6 candles. So $1.64. So for me, I could go with $1.50 or I could go with $1.75. I always like to go higher. I always like to round up. And if I can, I'd round up to a whole dollar mark. So if I rounded this up to $2, so my risk would have to be $2. But I don't want to do that. I want my risk, I have to keep my risk a little bit tighter so that I could trade this with enough position size to where I could make profit on it. So now the question becomes, I know the range. So what's the position size am I going to go in? We have to go back to what we talked about last week. We have to go back to our max loss per day. And then how are we going to split that up? So my max loss per day is $600. All right. And I could do it, split it into 2 trades of $300 max loss or 3 trades of $200 max loss. Okay, June, it's the summertime. This is one of the tweaks I'm making. Instead of risking $300 per trade, in the summertime, I go to $200 per trade. But in this case, I was risking $300 per trade. So my position size, in order to give this $1.50, has to coincide. So if I go in with 300 shares and I give it $1.50, I'm going to be over my max loss. So if I give it 200 shares and I'm risking $1.50, I'm going to be right where I need to be. So 200 shares is the position size. $1.50 is the max loss. I have to keep it simple because I have dyslexia, dyscalculia, so I have to use these whole dollar in 100 share increments because it makes it easier for me to figure. And rounding up or down makes it easier for me to quickly figure how much room I need to give it. So in this case, and remember, right now we're not talking about profit targets yet. We're talking about protecting your investment, managing the risk that you're going to incur on a trade. And remember, I told you, whatever you plan on risking, as soon as you take the trade, write that money off. If you write it off, what it does is you kill the emotional attachment that you have to that money. And that's what we have to do. We cannot be emotionally attached to whatever money we're risking in the trade. I know the trade costs X amount of dollars, but I know theoretically that's a risk, but that's not what in our minds we're technically risking. We're saying that we're going to get out of the trade if we lose this much money in the trade. So that's the risk that I'm talking about. We have to write off that type of risk. So in this case, the stock took off. It hit my first target, didn't quite hit the second target. I really should have taken profit up here, but it didn't quite get to where I wanted it to. And it came back, had to stop out at break even. All right. Once you get in a trade and once you take profit, stop automatically moves to break even. The worst thing you can do is take profit and then turn around and give it all back because you didn't want to stop out at break even. All right. So you got to do that. I mean, you have to protect the profit that you get. The name of the game is managing your risk and protecting the profit that you do get. And, that's what we did here. So let's look at the 2-minute chart and we're going to talk about, now this is using the range strategy. I'm getting too far. This is using the range strategy for my stop. Okay, so I mixed the range strategy, which is telling me I can give it $1.50 and I can trade 200 shares. So using that range strategy as my max loss stop, this is my max loss stop, I'm able to determine what position size is correct for me to take this trade. Now, the technical strategy, the technical stop strategy is using a loss of that technical level you base the trade on to tell you your trade plan is dead. So I'm using the opening range breakout. And if a stock comes back and closes below this line and then makes a new low, technically I'm out of this trade. Technically the trade has failed because it failed to hold the technical level. All right, if a candlestick comes like this and it just dips down and then comes back, this is not a claim of the level. We just dipped back below it. We didn't reclaim it. So unless this hits your max loss stop, you're still in the trade. If this hits your max loss stop, you have to stop out. And if it resets up, you can always get back in. And you see me do that often. I'll have to respect my stop, then I get back in and I end up making money. You can't sit there and bitch about, man, if I had just waited, I would have made $300 more. If you sit there and start thinking about that, it's going to screw you up the rest of the day. It's going to screw your trading mind up. This is part of the game. These are the hits that we take in order to make more money. Okay, that is what it boils down to. But whatever the case is, your technical level needs to be inside of your max loss. If your technical level is outside of your max loss, you don't take the trade. You don't take it because you can't manage your risk. I don't care how good it looks chart wise. If you can't manage your risk, you don't take the trade. That's the discipline part. That's what keeps you safe and keeps you in the game long enough for you to start making some good money. But so this is a technical stop strategy. Excuse me. And I use both of them. I use the range to set my max loss. So it tells me if it starts trading outside of the range, the trade's probably going to die. And I need to protect the money, the rest of my money. I don't need to dig into what I didn't risk. And we have the technical stop, which if it gets taken out, the technical level gets taken out, your trade is dead, you take it off. Now, yeah, if it turns around and comes back, you can get back in. You didn't take your max loss. You can get back in and you can probably make 2 or 3 times what you lost. You know, that, again, that's the name of the game. All right, so we're going to look at another example in a minute, but I want to go to the candlestick strategy. And what a lot of new traders do, because they're just getting started and you're trying to wrap your mind around what's going on and you're trying to kind of get yourself acclimated, you just use a candlestick method. Meaning, okay, you get in, here's the entry on the 2-minute chart. We get in on the 5-minute chart, and you could use the 2-minute chart as your guide. This is why I use a 2-minute chart. I still use it because when I first started, this was the stop method I used to use. I would get in and I would give myself 1 2-minute candle as a guide to stop. So if I got in here and we took out the previous 2-minute candle, if we took out the low, I'm out of the trade. Okay, and what it does is it developed my discipline to stop out when I hit this certain level. Stop out, stop out, stop out. Yeah, I had a hard stop to protect me from myself. That if I didn't do that, I would still get stopped out and I wouldn't lose any more than what I initially risked. But this helped me develop the discipline to be able to take these stops off when they trigger without me having to set something in my platform to do it for me. Okay, so this was part of the growing process, the candlestick. You never let the stock take more than 1 candle from you. Any trade you take. Now, some trades that are too volatile, that have too large of a window, even on the 2-minute candle, again, you don't take the trade. If you can't manage the risk, you don't take the trade, right? I know it sounds simple, but it's hard. And you wouldn't believe how much flack I get for shutting down my account at 10:30, 11 o'clock and not really doing much the rest of the day. You know, and my question is, well, how much money are you making? And The guy Friday was like, none, because you're not there to help me. Say, aha. I'm not there because you should not be fucking trading. I'm sorry, but that's what I said. There's a reason why I shut it off. I'm showing you guys, do not trade. Especially on a Friday before a long weekend. All right. We all saw the volume left around 10 o'clock. Everything died. I took 2 trades after 10 o'clock, and I lost like out of the 2 trades I took, I lost $200. I had made over $800 before 10 o'clock, and after that I lost 200 of that. So why the hell am I going to fight that crappy price action? This is why I am where I am today. And I'm desperately trying to teach you these lessons. Desperately. I'm not far away from my computer. I'm listening to news. If something happens, I'm coming back. But I'm working on other projects. I'm doing different things. Because if you sit here and you look at these charts, man, I'm telling you, you're going to see things that aren't there, and you're going to lose your money. I'm not going to go off on that, right? All right, so here is, no, not Facebook. What's SQ? That's the one I was looking at. SQ. All right, so here's SQ. 5-minute opening range. Okay, we've got a huge candle here. But if I had gone off of, let's say if I had gone off of this candle, my range would be like 37 cents. So I would give it 50 cents, right? You can't give SQ 50 cents. You can't. So you have to go off of all the candles up into the one prior to you going in. So you don't know when it's going to trigger. So you always just, the candle that prints, you just go by. So here, 91 cents, $1. I don't like giving SQ $1, but that's the rule. 91 cents, I'm going to average it up to $1. So I'm going to give myself $1 stop. My max loss is $300. So what position size can I take? 300 shares. And you guys saw me take 300 shares. Okay. So we got 300 shares. My stop is $1. We didn't even test that. We didn't even test that. And we were able to take profit on this. But the point, again, we're not talking about profit. I need to stop. It's about the stop. So the technical level was here. You get in at 224. Your stop is at 223. That's $1. Your stop's down here. This stock has a lot of room to play around before it makes the move. Stocks rarely go straight to whatever your target is. It goes up, pulls back, goes up, maybe pull back again, depending on how good the price action is. So we have to respect the stop that we put in. We respect the technical stop here. This candle opened, it sold off below below the 5-minute opening range high, and then it bounced. If I had taken it off just because it dropped below this, I'd have been stopped out. It needs to claim. If it doesn't claim it, all it's doing, this is just normal volatility. These are market makers picking up orders. That's all it is. So that's where we were on that. $300 300 share position based on the $1 stop. My hard stop was $1. Technical stop was 5-minute opening range low. So if you're in the part of using the bar, not the bar, the candlestick. If you want to use a candlestick, here we get in again at 224. The low of the previous candle, you don't want to lose the candlestick, is 223.15. So you could put your hard stop at 223.14 or 223.10. You're still within that max loss window, and you're still within the range, so you can make money on this if it works. All right, and that's the key here. We're managing our risk so that if it works, we can make money, and that's what this is all about. So that's SQ. I've got one more to show you. I'm running overtime, probably because I ran it. I didn't want this to go past 30 minutes. But RBLX, this is one that blew me up on the 25th. See if I can find it. I believe it was the 25th. What day was this? Yep, 5/25. Yep, right here. All right, so 5-minute opening range low. Okay, 5-minute opening range low is the setup. You can see we were selling off. We had this huge candle. So what's the range? The range is gonna be $1, because look how small these candles were. This was only a 24-cent spread. This was only a 30-cent spread. And then we had one candle here that was, over a $2 spread. So it's not going to average out that huge. So we've got $1 that I'm gonna play with. All right. So the entry when we break the opening range low, you get in. Okay. There should be a little bit of delay. You should delay your entry. I didn't. I was aggressive. I'd already jumped in on this candle too early and got blown up. I was aggressive and jumped in as soon as we broke the low. Okay, $1 is my stop. I'm in 300 shares, and it takes me out immediately. This is what can happen. This is exactly what can happen. We get in, let's see, 87.65. So 88.65 is the stop up here. Let me change it so we won't get it mixed up. Okay, so here's the stop level up here. So we take our max loss stop, and this sets up again. If we traded this again, now my account was locked, so I couldn't trade this anymore. So if I gotten in here again, let's say 87.50, we had a 2-point gain here. We practically had a 2-point gain, and I'm pretty sure, oops, wrong trend line. And I'm pretty sure 87.50 or around there would have been a target, or 85.50 would have been a target. So stopping out using your max loss stop And then if the thing sets up again, clear rejection off of the 200 here, clear rejection. We jump in when it breaks the low. We've got 2 points that'll make up for the 1 point that we lost. What if we didn't stop out here? What if we just left it and we ended up stopping out all the way up here? You know, when it took out the 100. I mean, that we had no chance of eliminating this with when the trade actually worked. No chance. So we have to be careful with this. No, we have to be. Looking at this on a 2-minute chart. Let's see if I can find it on a 2-minute. I don't know if I can go back that far. Nah, it won't go back that far on a 2-minute. But you guys, you get the idea of using the bars as the stop. But I hope you understand how I use this. Now, I use it every day. And now that we've covered this, I'm going to illustrate it more in the live webinar every day. So you see exactly what I'm doing and exactly how I'm managing my risk. Okay, I'm going to be honest with you. These guys that it's like they want to prove me wrong. If I'm saying that, look, we shouldn't be taking these trades, this is not the right setup, and they take it, and if they make money, it's like, yeah, see, look. But it's not about that. It's not about one trade. It's about a series of trades. It's about a week of trades. It's about a month of trades. Where are you at the end of the month? Okay? That's what we're talking about. Where are you at the end of the month? What's your equity curve look like? That's what it's all about. All right, so what I'm going to be doing, I typically every month I wire out and I start with around 30K. That gives me a $5,000 cushion over the 25 grand that I've got to have in IB. And what it does is it makes my trading more relatable to you guys that may be in smaller accounts. You may be in CMEG with a $5,000 account. I can only risk that 5 grand. If I lose that, I can't day trade anymore. So it's no different. That 25 just puts me at zero. Basically, you put the 25 grand in and it puts you at zero. And then you only have the cushion above that to really trade with. And so I have to still use these methods every day. That's why I am where I am. That's why I have the equity curve and am able to do these things. So we'll close this out. We'll look at what my week looked like. Let me get this switched. So I had a red week. I ended up losing $86, less than $100. Reason being, I got my head together. And then what really pissed me off, that $200 I lost on the last 2 trades I took me red on the week. That's really disheartening. I don't care if I'd have just made $5. not having a red strike is is worth its weight in gold. But these are the two max loss days. 25th was RBLX. I got hit twice on that and couldn't trade anymore. And Wednesday, same deal. But you could see you're gonna have struggles. You're gonna have bad days. You're gonna have days where you just don't make what you want to make. And you don't throw it in. You don't throw in the towel. You come back next week and you do the same thing that you did these 3 weeks. You do it again. If you have a process that over time works, it works. So 67, 68, 88 for the week. Equity curve for the week took a little hit. Only down less than $100. But if I'm gonna have a red week, I would love to have a red week under $100, because it's gonna make it so much easier to get back on track next week. So one more week in the second quarter. We'll see if we can put in enough. If I could duplicate May in the slow month of summer, it'd be amazing. It would be simply amazing. So come in, stay tuned, stay focused. I'm going to continue to try and warn you guys off on the afternoons that just aren't right. In the mornings, if it's not worth pushing it, we're not going to push it. So I don't think I can do anything more, other than be the example. Be the example. And when I fall apart, I'm going to be the example in showing you how I put myself back together. Because you're going to have to do that. You're going to have to do that. All right, so that wraps it up. I'll see you guys on Sunday. We're going to talk about the state of these swing trades. We had some that worked, but for the most part, we had a little bit of choppiness. But we're going to talk about that tomorrow. I don't want to get too deep into it now. But you guys, if you have any questions, as always, ed@AverageJoeTrader.com. Shoot them to me. I'll be glad to answer them. But enjoy the rest of your weekend. Take time out on Monday to reflect and honor these soldiers that gave the ultimate sacrifice. And we'll be back at this thing bright and early Tuesday morning.